Again, you don't see deals like this that come around all that often, but you do sometimes. And those are the times that I'm talking about right now. And in a way, that's really what all good trading is.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 24, Commitment Issues. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get that frequency bounce back from, the more you grow as an investor. The second thing you can do is to support the show with a paid subscription. For the cost of one of those fancy Starbucks once a week, you'll get video extra podcast episodes and option trade posts where I drop down into the deep end of the market, share some really deep knowledge about a subject, and share trade rationales and chronicle my covered call and cash secured put trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and much more. To get all this, go to my Substack at wealthbuildingwithoptions.substack.com and subscribe to the monthly or annual subscription. Now, let's tune in to higher frequency trading. One thing that can be said about covered calls is there's bigger gains and there's bigger regrets. Because, as they say with covered calls, you're always selling your winners. And yeah, that's a truth, but in some ways it's a partial truth. It's a technical truth. So, yes, when you get assigned, you're selling stocks. And we've already talked a little bit about objectives. And maybe you want to sell that stock, but still, you're only selling it if it's a winner. There's a guy that I used to work with who was a mentor to me. And he used to say this thing, there's the kind of stock you date and the kind of stock you marry. And there's kind of something to that, right? There are some of those stocks that, well, at the time, it feels like you're just going to hold until you die. Let's think people who bought Apple back in the 80s, right? There are definitely some of those where, I don't know if I'll say married. We'll talk about that in a second. But yeah, you just want to hold them for a while. But, then there's some of those where you look at it and holy cow, it's made a great run. And geez, maybe this will go up forever. But really in the back of your mind, yeah, I'm going to take her for a spin and make some money, and that's probably it. Really, everything is impermanent, isn't it? I mean, like everything. Think about things that you plan to do forever. Well, you're not going to be here forever. You're going to be here until you're not here. And in the big scheme of the universe, not to like bring down the room here or anything, and not to get philosophical or anything here, but in the big scheme of the universe, you're only here for a second of time, a fraction of a second of time, right? That's what it feels like for the universe anyway. So, I mean, everything's impermanent. Even those stocks that you want to hold forever, you're not going to hold forever. Think in terms of value investing. Why do you buy a stock? Well, if you're a value investor, and by the way, I know that everyone who's listening to this is not a fundamental stock investor, not a value investor. That is something that I think is pretty useful as we talk about time to time on this show, but it is a skill. But value investors like Warren Buffett and those kind of folks, why do they buy stocks? Well, they buy them because Right now, the price of it is less than the value of it. And if the price is less than the value that they calculate, and that's why I said there's a lot of skill to it. If the price is less than the value they perceive it to be, they'll buy it, but they're buying it because right now the price is below the value and they believe that it should appreciate from where the price is to at least where the value is and probably higher. At some point when it's higher, well, then it's not worth holding anymore because it's overpriced. When do you sell those? When they're overpriced by a certain amount. Now, that brings me to what I want to talk about today: buy rights. Buy rights are great for those stock investors who have commitment issues and are not necessarily looking for a stock to marry, not necessarily looking for a stock to be in for the rest of their natural born lives and pass on to their heirs. In some ways, sort of a more realistic approach to it. What is a buy right? Well, a buy right is when an investor buys a stock, let's say 100 shares of it, and at the same time, as part of one trade, sells or writes a call on it. Buy 100 shares, write one call, which is actually a 1-to-1 ratio, right? Because each call represents the rights on 100 shares. Done as one trade, hit the button, hit the buy button, boom, you're filled. You got both of those legs of the trade. I introduced buy rights a little bit on the last episode. And this time, I want to really drill down on one type of buy right. In this case, a short term buy right. And probably on the next show or the show after this, we'll talk about long term buy rights because the way I think about them is you think about them pretty differently: short term buy rights and long term buy rights. So let's talk about the short term buy rights. Why would someone want to do a short term buy right? Well, because they want to own the stock, but they're not really long term committed. And when I do these trades, it's usually because there's some problems with the stock itself. Maybe I like a lot of the fundamentals, but there's this big warrant that they sold out that really can potentially dilute the shares. Geez, why did they do that? That kind of weighs on the stock price. It turns all the good things into a sort of thing. Or, I mean, it could be anything really. You like the stock, but recognize that there's some problems with it. You might want to just dump it if it goes up in the short term. And the call premium that we use, A, as a hedge, and B, as a way to sell the stock at the strike price plus the premium, that premium in and of itself really is the key to the whole rationale for why you would do a buy rate, especially a short term buy rate in this case. It's got to be a big enough premium. Like maybe there's a $30 stock and you like it. Maybe it's got a good P ratio, a good price to book ratio, an acceptable cash flow scenario. But maybe their current ratio is like zero point 0.3, not exactly as good for liquidity as you'd like it. And yeah, maybe they did issue some preferred stock or warrants or something that might dilute the shares. And you think, oh boy, there's a lot of good stuff about this and it's been trending higher. I like it. I would definitely take a chance on this, but boy, I'd like to own it at a lower price. And I mean, if it goes up, yeah, I'd dump it because it's not something I'm really committed to. So it's a $30 stock, and maybe you can sell a call that's like, say, 5% out of the money. So $1.50 higher, 34 and a half strike for like 3% of the stock price. So 3% of the stock price would be 90 cents, right? It's not one of those things that you see all the time. Usually you couldn't do that, but sometimes you can. And we'll talk about a more realistic example of this in just a minute. So you look at that and you think, okay, well, I like this stock. I wouldn't mind taking a chance with it and being able to sell a call that gives me an extra 3% cushion. I mean, it's not huge, but hey, if I do that again next month and the month after, if I still like it after this month, now we're at 6% or 9%, and now it's really making a difference. Which is an interesting thing about these buy rights, these short-term buy rights, is you put them on as a buy right, but then you end up rolling the call for a couple periods, which is kind of more like a covered call then at that point, and they make a difference. So that's the downside part. As far as the upside part goes, I mean, if the strike is already 5% higher and then you're getting an extra 3%, I mean, geez Louise, if you can make 8% in a month, I mean, that's great, right? Even if you think the stock can outperform, if you annualize that 8% in a month, I mean, geez Louise, that's 8 times 12. That's 96%. Again, you don't see deals like this that come around all that often, but you do sometimes. And those are the times that I'm talking about right now. And in a way, that's really what all good trading is. All good trading is waiting for, well, as John Kamisic likes to say, and he's actually quoting a guy who's quoting a guy, but I'm looking for money lying in the corner. You wait for those great opportunities. And man, when you get them with these short term buy rates, they can be just super sweet. But what I think is important is, what do you really want? And that goes with one of the things that I really like to share with my market taker mentoring student traders is think of 3 different ways to trade this opportunity and pick the one that you think makes the most sense. So you might see this opportunity and you might think, man, this is a really, really great opportunity. If it goes down, I've got this cushion to the downside. It's only 3%, but as long as it doesn't dip a lot this month, or if it dips a little bit next or this month and I can roll next month, I can make back what it dipped this month, all those things that I described. And if it goes up to the upside, sure, I'd like to hold it for longer, but that's a really good annualized return. Okay, good, good. But last episode, we talked about the synthetic relationships between buy rights slash covered calls compared with selling a put. So, what if instead you sold a put, cash secured put out for a month? And maybe you didn't sell the same strike, which, if we're talking about selling a 5% out of the money call, that would be a 5% in the money put. What if instead you sold an at the money put or a slightly out of the money put? If this stock's at 30 bucks, well, I guess if you could sell the 31.50 call at 90 cents, you could probably sell the 29 and a half, so only a 50 cents out of the money put instead of $1.50 out of the money call. And puts tend to have higher volatility than calls. So, moral to the story is you could probably sell that put for even more. You could probably sell that put for like 5%, maybe 6%, which comes out to what? What's 5%? Well, I guess it's $1.50, or 6% would be $1.80. Rare opportunity, but you can find them sometimes. Maybe that makes more sense. You get more cushion to the downside, but less room to run to the upside. A little bit of a trade off there, but that's kind of how it goes with all option trading. All option trading really is some sort of a trade off, isn't it? Trying to choose between one position or another or among a few. So I like that opportunity. Let's sit and think about it. What do I really want? What's more important to me in this situation? The protection to the downside or the room to run to the upside? Or am I not really sure? In which case, I could sell an at the money cash secured put or buy an at the money buy right, which ends up really being about the same. And if it's not the same in an obvious, intuitive sort of way when you calculate the money you make, it might be when you take into account the things we talked about last week, where if you're buying the stock, you're not earning interest on that cash. And so if you sell the cash secured put, even though you might make less, you're kind of getting more because you have interest that you're earning on the cash that you're not buying the stock with. So, anyway, if we go the short term buy right route, and okay, by the way, I'm doing a lot of by the ways this week because there's just a lot of sort of ancillary stuff to talk about that's really important. So, another by the way, how short term is short term? I would say anything under 2 months. And if you want to look for a scenario like the one that I'm talking about, where you're really getting a pretty juicy, meaty premium, you, you're not going to get that if it's a week long option or even a 2 week long option. It's usually got to be about a month or so. 3 weeks to 2 months is usually about the sweet spot for these short term buy rights. So imagine you buy one of these short term buy rights. I buy the stock, I sell the call, and expiration comes around. So this is really the important thing. I spend a whole bunch of time talking about setups because they're super important. We want to start out the trade with the best money making opportunity that we can possibly start the trade out with. And that's super important. There are two parts to every trade that you have control over. There's the price and time and option you get into, and then there's the price and time that you get out of that option. Everything else is just taking advantage of what you observe happening in the market. That's it. I guess your plan is the in between thing here, but the plan is, why am I buying this option? It's because I think I can get out of it at another time later. So arguably the plan is where you get in, right? So once you get in, which of course would be because of the good premium that you get and all the things we already just talked about, once expiration rolls around, what do you do? Well, there's only a couple of categories of permutations that can happen. The stock can go up above the strike price, the stock can go down too low below your break even, or the stock can be in that sweet spot where you end up outperforming the market. And arguably, it should end up in that sweet spot more often than not, or at least pretty darn close to it. So, what do you do? Well, you can do a couple of things. One is you can just close the whole darn thing down, put it in order to buy back the call and sell the stock as part of one trade, selling the buy right. Or technically, you can also just let the call expire and then sell the stock on Monday. There's risk to that, what I like to call gap risk. And it's not just me that calls it that. It's everybody who calls it that. It's a thing. Gap risk is okay, so I had this call providing downside protection, but now I let the call expire. And Monday, oh no, the stock that was at 30 now opened at 15. Whoopsie. Well, the reality of it is that call wouldn't have been providing you that much more protection anyway. If it was going to expire and it's on expiration day, it's trading for close to zero anyway. So it doesn't matter. So I guess moral to that story is I personally, if I'm going to close the thing down, I prefer to get out of the entire trade on expiration day. Now, there are some caveats there also. In fact, when I was recording this episode, which was really just a few days ago, this past Friday, for those of you who are listening to this as soon as it comes out, that was July 18th. I'm recording this. That was a monthly expiration, July 18th. And I actually had a stock kind of like this. I mean, really, it was more of a covered call rather than buy rate scenario. And it was one where I actually did the put, cash secured put, instead of the covered call. And that was in OKTA, OKTA. It was one where I had a covered call for a long time. And it finally got assigned at $98 a share. I was short the 98 strike. And a little bit later, it wasn't the Monday afterwards, I sold the 96 puts. So if I were to get assigned, I would be scalping a couple bucks out of there, which is great. And that actually was my plan to get assigned. And the reason it was my plan is because the options on Okta aren't super liquid. I mean, they're not terrible, but they're not super liquid. So I was just going to accept assignment, own the shares because I'd be buying them back $2 lower, and then go back and sell that 98 call. Heck, maybe do it again, accept assignment on those and sell the 96 puts next time. You can't count on that long term. Most stocks don't stay in a short range for that long. But that was my plan because it's kind of hard to roll in that. So I did look at it and figure that I could buy that put back, which was in the money for maybe 5 cents over parity, which is like buying an out of the money for 5 cents. And then I looked at what price I could sell the monthly expiration. So that's the August monthly expiration because monthly expirations always have more liquid options than weeklies. Now, I say always, always is not a real word when it comes to option trading, right? There is no always, no guarantee, and also no never when it comes to option trading. Everything is just waiting for that black swan to swoop in on you and something crazy to happen. But the monthlies for next month were actually pretty liquid. They were 15 cents wide. So I figured, okay, if they're 15 cents wide, I don't want to sell the bid. I want to sell like a nickel above the bid. And then I just looked at what is parity in the money puts, and they were in the money by like $1.15. And I could sell the August 95 strike put, so still going yet $1 lower for 330. So I could buy back the puts I'm short at. I was sizing this up to see if I could do it and putting in an order to do that. If I buy these puts back, $1.15 is parity, meaning all intrinsic value, no time value, which is great. It's like buying the put back at zero. And then selling the new 1 month, $1 lower strike, 95 strike puts in August at $3.30. So I just said, okay, $3.30, which would be a great place to sell it. It was 325 bid, 15 cents wide. I would love to do that. And then buying the other ones back for effectively zero parity, 330 minus 115. Okay, so that's 215. And so I put in an offer to sell at 215 and ended up getting filled, which I was surprised by because I thought this was going to be so illiquid that I would have to take assignment on it and then sell calls. But I rolled it and it gave me a little bit more downside, which I actually really like because from my fundamental analysis, which I mean, everything's a work in progress in life, right? I've been trading options for over 30 years and I'm still striving every day. Yeah, maybe not every day, but every week, every month, every year to be better than I was last year or month or week or day. And I'm definitely striving to do that with my fundamental analysis as well. But, from my fundamental analysis with it, I feel like it's an okay stock, pretty good. So putting in a lower strike to buy it just makes it even a little bit better from a fundamental analysis. So I ended up loving that trade. And this time it started as a synthetic buy right, if you will, which is a cash secured put, using already lower strike, the 96 strike, became in the money, which was part of my plan. I just kind of changed the little thing at the end. My plan, instead of accepting assignment, I did the roll. Those are basically the three things that you can do at expiration. You can just close the whole darn trade, ideally as one trade. If you have to, because the markets are too wide and too illiquid, the bid ask spreads, let the call expire and then sell the stock on Monday. Or you can roll it, which is what I described. And again, even though the show is about short term buy rights, synthetically, that really was a short term buy right. That was how my brain was thinking about it. And it's funny with option trades, even though they're very mathematical, very black and white, very left brained, how you think about them makes an incredible difference in how you trade them and how you perceive the success of the trade. So, okay, back to our three things that can happen. The trade can be over, you close it, you can roll it. And if this was a proper buy right where I owned the stock and was short a call, if I were to roll it, I would just obviously be rolling the call. In stock, you can't roll. But the third thing we can do is accept assignment. And there are some times where I would accept assignment. I think if it was a stock, like let's go back to that hypothetical example that I just had. If I bought the stock at 30 and at the same time, as part of the same trade, a buy right, I sold the 31 and a half calls for 90 cents. I think if that call was in the money at expiration, there are a lot of times where I would just accept assignment on it. That annualized return is fantastic. And I've got a lot to say about annualized return, and we'll, I'm sure, do at least one whole episode just on that, and it'll probably be part of a couple other episodes because there's a lot to unpack when it comes to annualized return, including and especially the fact that in some ways annualized return is baloney because you can't always replicate that trade, which is the whole premise of annualizing returns. Hey, if I make 5% in a month, 5% in 1 month times 12 months is 60% in a year. Hey, it's like I earned a 60% annualized return. It's like putting my money in the bank and earning 60% on my savings account passbook, right? Which you'll never do with Chase. My gosh, you're lucky if you earn if you're in 0.6%. Goodness gracious. But hey, I digress. But one really good thing to think about when it comes to annualizing returns, and the correct way to think about it when it comes to annualizing returns is think about it like putting your money in the bank in a savings account or in a CD or in a T bill, treasuries in general, the risk free rate. If you can put your money in a high yield savings account that's protected by the FDIC, and you're under the threshold for protection, so you're fully insured, can't lose. And let's say you can get 4% on that. Well, I mean, that is a baseline. Another baseline is the stock market is supposed to earn 10% in a year, 8% if you account for inflation, although now inflation is higher. So that's maybe a little bit of a different paradigm. And you have to start thinking, well, if we had such a great run here, are we still lucky to be on that 10% a year thing? And you should probably honestly fade that and not think that way because if it's up or if it's down, it kind of doesn't matter if you think about it from a random walk or log normal distribution standpoint. Wherever here is a year from now, you assume 10% higher regardless. But that's another baseline to consider. So 4% risk free rate or whatever the risk free rate is, wherever you can get a guaranteed interest rate. Or, hey, if I put my money in the stock market, statistically, I'm going to make 10%, and it won't be 10% this year. It could be one of those years it's down. It could be one of those years where it's up 20%, but statistically, it's 10%. And so you think about it as if it's 10%. But if in this month you can earn, what did I calculate it out to be? 8%. I mean, that is 96% a year. So this month, that is the rate at which I was earning on that capital in hindsight if I got assigned. So, yeah, a lot of the time, most of the time, I'm just going to take assignment like I did with Okta. And then if it makes sense, I'll just wait until it pulls back and write a put if I want to get back in and in a perfect world, a lower strike put. That's how it goes. Not that this is always going to work out perfectly. And honestly, it didn't really work out perfectly with Okta either. Again, I'm recording this on July 18th, 2025. I mean, that one, when did I get assigned on that? And sometimes you see this where, sure, I want to sell the stock at 98. I'm going to let myself get assigned and it runs up to like 150 or something like that. And then you feel like you left money on the table, but it's still a decent win. And that's just one of those outlier scenarios that's going to happen time to time. And it is an outlier scenario. It doesn't happen that much. You feel like you made a mistake, but you didn't. It's just part of the game that you're going to miss out on some of those sometimes, and it's fine. It really is fine because most of the time that doesn't happen. In fact, I was really kind of going down a rabbit hole on this the other day and thinking about the log normal distribution, which is shaped as such because stock prices observe like log returns. And so it's shaped with that big, long front tail because of these rare times when the stock just kills it. But most stocks, did you know this? Most stocks actually don't make money. Isn't that crazy? We think they do because the S&P 500 makes money 10% a year on average. But that's because there are people who are picking those 500 stocks and they think they're good stocks. They're basically stock pickers. It's kind of like well, for those of you who are of an older generation, like a mutual fund, which I think they still exist, but I don't know why anybody buy a mutual fund these days. But most corporations that are listed, they get listed and they kind of putter. Maybe they have a good run for a bit and then they reverse and the stock goes to zero. I mean, sometimes they're big and high profile. I mean, we can think of tons of those. Is Lucent still a stock? I'm pretty sure that was one that was like that. It was a darling in the 80s and went to zero. What about Copper Mountain is one that I can think of. I remember buying that stock and that what they were doing is they were laying, I don't know, some sort of high speed cables through the mountains to make the internet faster. This was back in like the late 90s. Oh my gosh, I'm really dating myself. But that company doesn't exist anymore. They were a darling for about 3 minutes. Most stocks actually don't even make money. So that's why you get that log normal distribution because stocks make log returns, meaning you can reinvest and the profits are exponential. You make more at an increasing rate and you lose at a decreasing rate, which is kind of why calls function the way they do, right? So the moral to that story is, yeah, we don't worry about the ones where, oh, I got assigned at the 98 strike and now it's at 150. You want to beat yourself up about it, but you shouldn't. Doesn't matter. It's just one of those stocks. And if you're doing several covered calls in your account every day for years, Not like you put on a new one every day for years, but you have a few on at any given point for a decade. That one that got away doesn't matter. Remember, we have commitment issues. We don't care about the one that got away. So, anyway, we either close the trade, we roll it, or we accept assignment. And I mean, these are trades that I do these time to time with. I mean, I don't always do them. I mean, one of them that I did it with, and this is actually a really interesting one to take a look at, especially from the synthetic standpoint, is Rigetti, RGTI. Now, this is not one of those value stocks by any stretch of the imagination. They are a quantum computing company, and quantum computing is not really even a thing yet. It's like maybe gonna be a thing one day. It's like crypto back in the day. Or maybe it's like that stock Copper Mountain back in the day. You don't know. But supposedly it'll be a thing in the day because there are some companies that need quantum computing. It's faster for what they do. It's not, they're not going to replace everyday computers, but they're going to do some things better. And that's one where I had a buy right on, and I had it in my trading account, and it was a short term buy right. It was exactly what we're talking about here. And then I realized that I was going to do my total earnings domination class with Market Taker Mentoring, where we trade earnings, a very different thing than what we talk about here on Wealth Building with Options. But I just wanted to get it out of my account because people watch me trade earnings trades live in total earnings domination. But I kind of still wanted the trade on. So I just simply closed the buy rate that I put on at close to break even. It was either a small loss or a small win, didn't matter. And I just moved it into my IRA, but I moved it into my IRA as a cash geared put. And I did it, if I'm not mistaken, I did it like right at the money at the time. I think it was around the 12 strike, and I sold the 12 strike puts that expired in like 3 or 4 weeks. And yeah, I just thought about it like that. And I really loved selling the at the money puts because that's where you get your greatest time value. Time value is the benefit that you get out of buy rights or covered calls or cash geared puts, selling any sort of option. As I'm looking at it right now at about lunchtime, I'm kind of getting hungry. At about lunchtime on July 18th, 2025, I could look at the 17 strike puts, which are the closest to the money, and I can sell them for 219. That's more than 10%. Or I could sell the 16 puts that are a little out of the money for about $1.62, which is just shy of 10%. So these situations, I mean, they do exist, they do happen. But, there's a lot of risk to it. I mean, a month from now, somebody could say, that whole quantum computing thing, we don't need it. I don't know. For whatever reason, it could fall out of favor and not become a thing. Or Rigetti could have some big breakthrough and they could sell one of their quantum computing early stage things to some company that orders 100,000 of them and the stock could shoot to the moon. And that's the risk with these long term buy rates. But let's go back to that log normal distribution. Those big unexpected up black swans, that's just the risk you have with some of these things. And it being a company that goes to zero, well, that's the risk you have with these things too. But it's probably not going to happen tomorrow or the next day or the next day. In a lot of ways, these short term buy rates on riskier trades, riskier to the upside or the downside, they're kind of hot potato trades. We're playing that middle of the log normal distribution, the sweet spots on the P&L diagram, and hoping that we can keep it on in that sweet spot for a couple of months. Because look, man, if I can collect 10% a month, for 3 months, I mean, geez, that's 30%. We could just hold the stock. And I mean, if we really do believe in it for the long term, sure, I'll take it at a 30% discount for having a couple sleepless nights during those 3 months. That's kind of the way to look at these. And really, you shouldn't be having sleepless nights. You shouldn't let the emotion get to you. You should just realize it is a statistical game. And if I do this on 50 stocks throughout my trading career, most of them should work out pretty good because of the risk premium in options that we have talked about in previous episodes. So we covered kind of a lot of stuff here. We really went the full gamut and fleshed out everything you really need to know about trading these short-term buy rates. And so that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And please leave a review. When you leave a review, that helps Apple and Spotify and all the platforms know that you care and that you like it, or at least are interested in enough to leave a review. And hey, that benefits the show, which benefits the whole community. Now, when you do subscribe in Spotify or Apple or whatever your favorite platform is, you're going to be the first to hear episode 25 because a little notice pops up on your phone that says Wealth Building with Options episode 25 is out. So do that for yourself. Do that for me. Do that for the entire community. And I will see you next time. In the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.